Hi, welcome to Trading with TK, teaching you to turn ideas into money. We're at www.tradingwithtk.com, and this is the weekend wrap-up where I do a question and answer period. Some of my readers write in some questions, and I try to answer them. So this week I got a letter from Alexander from Germany, which is funny because last week I got a letter from a guy from Italy. And, I'm taken by that because it shows me that the internet has made the world a lot smaller than it used to be. And it also tells me that we're really all neighbors now. So I'm taken by that. But anyway, Alexander writes, and I'm going to paraphrase this because I got a letter from Joe also who touched on the same topic. So, and Joe also touches on window dressing. But Alexander wants to know why I never mentioned option expiration in any of my blogs, and he wants to know what kind of effect it would have on the futures market and the specialists on the floor. Okay, it's a good topic, but I'm not an expert in options, but I've had some experience dealing with these guys, and I'm going to tell you what I know about it. Okay, first of all, anytime I've ever traded options, I've lost money as a regular customer because the clock is always ticking away on you. What they do offer you is tremendous leverage. Okay, but you got to pay a premium to get in, and that's where the dealer makes his money. That's the guy who makes the money. The dealers are the guys who make the money all the time. The outside people who are buying them because they think the stock is going up, most of those guys lose money. Every once in a while, they get one and they get 4 or 5 times their money, which could be the worst thing that could happen to them because now they're suckered into this for the rest of their lives, and eventually they give it all back because most of the options expire worthless. Okay, so that's my personal view of trading options. But like I said, the guys who make money are the dealers. Okay, but also option expiration day carries with it this myth of the boogeyman under the bed syndrome. And because it has this boogeyman under the bed syndrome, it chases away a lot of the players on that day, and you tend to have a very quiet, boring day because of that. They're all waiting for this option expiration to pass because they don't want to get caught in any kind of gigantic move and look silly. So that's why basically why they stay away. Okay, but here's what the option guys are doing. The pros, what they do is their arbitrage. They're arbitrageurs basically. Okay, they buy this product which is long, and they hedge themselves over here with the opposite of a short. So they're long this, they're short this, and what they've done is they've locked in this spread in between. So regardless of which way the market goes, they've got this spread locked in. Okay? And what happens on option expiration day is when these expire, bingo, these guys get paid. It's payday for them because they're holding these until expiration. Sometimes they unwind a little of it. Sometimes they go out into the next. There's all kinds of strategies, but I'm talking about the basic strategy here. That's what's going on. So there's really no major influence at the end when they expire because there's no disparity between them. They're long 10 of these, they're short 10 of these, and they're just waiting for the spread for them to expire so they can collect their money. Okay, that's basically how the dealers make their money in options. So do they try to wiggle the stock to a certain price on option expiration day? They might, but if there's too many sellers there, no matter what they do, they can't get it there. And if they get it there, it's only going to be there for until the option expire, which is usually on around noon. And these guys have become so sophisticated that if they need to unwind, they don't wait till the final day. They don't wait till the option expiration day. They start unwinding days before. They start unwinding on a Monday or a Tuesday if they know Friday's the expiration. So it's very sophisticated. I don't see it having any kind of effect on the market or the way I approach the market. And if it does, it's a short-term thing. It's a blip, and the next day it'll self-correct itself. And also, there's no way of measuring what the effect is going to be. And if you think you know, the market's probably going to prove you wrong. So that's why I never mention it. It's never really a factor to me. But where did this myth come from about the boogeyman? Because something must have happened along the way for people to get this, and something did happen. Now, and I'll tell you what it is. If you weren't around back then, you're not going to know this, okay? But when the indexes were first created, which was the S&P index, which represented all 500 stocks. So you could buy one share of the S&P index, and you basically owned a share, had a representation in all 500 companies. It was a nice way for these money managers not to have to do stock picking, and they could just cover their butts by buying this basket. So if the basket happened to be up 20% for the year, they were up 20%. If it was down 20%, they were down 20%. They could always say to their customer, "Hey, the whole market was down 20. You're just with the market." So it was basically a way of not making major decisions on what stock to buy. Okay, so now they have these indexes. Then they create futures on the index. And then they create options on the futures and options on the index. Now it's getting very, very complicated. Okay, now this is all in the beginning when it all first started. The first arbitrage setup that came out of the index was program trading, it was called. And what would happen was you'd have the futures S&P and you'd have the regular 500 down here. And they would run up the futures, or buyers, they'd rather buy the futures, and there would be a disparity between the futures and the cash market. So what the ARBs would do upstairs is they would run out and they would short these because they're higher, and they would buy these. They would buy a basket of all 500 stocks, so they're leveraged. So they've got this spread locked in, just like the option guys. And as the spread would narrow, they would unwind. They would cover their shorts and buy, they would cover their shorts and they would sell their longs. And then when the process happened again, boom, boom. And obviously the first guys that were able to do this, the first guys in had the biggest margin profit. Okay. So that was program trading, right? Then came the first double or triple witching hour close, expiration. The very first one. And we had never been through it before. Well, on a Friday afternoon, there were so many shares paired off. For instance, I was running General Motors at the time. I think we had 2 million shares paired off. 2 million to buy, 2 million to sell. This is on the close. And like 400,000 or 500,000 to sell on balance. And here we had a price there. This was all over the floor. Some were to the buy side. Some were like 400,000 to buy. And because no one had been through this before, this was all new. This all came as a total surprise to everybody. But in the meantime, we had to price these things. We were running a market, and what we did was we took these stocks down as far as we could. If we had to buy 400,000 shares or 300,000, we'd take them down as far as we could. It was almost like the stop orders going off. But the numbers were so huge that it shook everybody up. So but by Monday morning, bingo, right back up again they went. Well, the exchange got very concerned about this. So in the future, what they did was from now on, anytime starting at 3:30, if you had a disparity in any of your stocks by 3:30, you had to display it on the ticket tape. In other words, $1 million to buy, $1 million to sell, and 300,000 to sell on balance. Then everybody would see that, and some of the big traders from some of the larger firms would start putting bids in or offers depending on where the disparity was, and it would soften up the disparity. So you never had these big moves again. But it only had to happen once, and that's where the myth came from. But since then, the markets have become so sophisticated that you never see that happen anymore. I don't remember it happening in years, but it did happen the very first time, and that's where the myth was born. So I hope that answers your question on options. That's everything I know about them. And Joe wants to know about window dressing. It's the same thing as the option guy trying to push the stock up to get it to the level he wants. If the market will allow it, he'll get it done. If the market won't allow it, he won't get it done. So there's no way of knowing whether or not they're window dressing or not. Do they try? Yes, I think they do try. And it's usually at the end of the quarter. And here's what they do. I wouldn't call it window dressing. If they have a stock that's just out of favor on the street, and they have it in their portfolio, they dump it. They don't want to have to show their customers that they're still carrying this dog. And the stocks that have been acting well, they'll double up on them. So the ones that are acting good that they already own, they'll try and push higher, and the ones that they don't like or the street doesn't like, they try to dump. So that's my take on it. And I'm sorry, but I'm running out of time, and I don't want to have to do this video over again. So I hope I was helpful, and until again next weekend, this is TK signing off.